there's a lot of advantages when you can find dividend stocks at a lower price, because if you can find dividend companies and you can, buy low, sell high, but if you can find them at a lower price, you can get benefits two ways. So let me give you an example. Let's assume that you can find a dividend company that's on sale and it's trading for $100 a share and they pay out a $3 annual dividend. So they're paying a 3% annual dividend. And then the company price goes up because you were able to get it at a discount. So now this company is innovating, they're able to make more profits, and the share price goes up. And for the purposes of this video, let's assume that it doubles in price. So now it goes up to $200 a share. On one hand, your stock investment is a lot more valuable because your stock investment doubled. But then the company might also increase their dividends to make up for this higher share price as well, because now the dividend percentage has fallen to just 1.5%, because $3 of a $100 share price is a 3% dividend, and $3 to a $200 share price is a 1.5% dividend. So if a company's profits are growing incrementally and they're seeing bigger cash flows and they have this cash to give out bigger dividends, then what they might do is they might also double their dividend. So now you bought in here. You were getting $3 a share, but now your stock price has doubled. So if you look at your stock brokerage account, you're going to see a bigger number there. Your amount has doubled. If you invested $10,000, now it's $20,000. But now your cash flow also doubled because you're increasing the amount of dividends that you're getting. And you can see a bigger increase here, assuming that the profits go up. But this is where it gets even more interesting, because this is just assuming that the company isn't paying out a bigger share of their profits and dividends, because what a company could potentially do is say, well, we are so much bigger now, we have less room for investment in our companies, we actually want to increase our dividends to $7 a share, because now they have bigger cash flows and they don't have other places to put it. So if you're able to buy low, get into these companies earlier on, you can see bigger benefit in the dividend amount that you're getting. So now your cash flows are increasing every single year, in addition to the actual value of your companies. So now you can win two ways. But in order for you to be successful here, you have to know how to research, because the mistake that so many people make, and it's a mistake that I made myself too, is you invest based off of this. You look at how much dividends a company is paying and you see how attractive the investment is. You might see a company that's trading for $100 a share that's paying out a $9 annual dividend. And you might say, holy moly, $9 a year, that's a 9% annual dividend. That's a great investment. And then you come in and buy. But what you might not see is that just a little while ago, the company was trading for $300. Sorry, you can't see it. $300 a share. So if the company has lost more than half of its market value, and the reason why it's losing is because it's on the verge of bankruptcy, and then you come in and buy because they haven't adjusted the dividend yet, you're just trying to catch a falling knife, but the knife is going straight down to the ground because you didn't do your research. That's why you do not want to make your investment decision solely here based off of the dividend. You want to make your investment decision based off of the company. How good is the company? How strong is the company? How innovative is the company? Do you like the company? If those are all there and they pay a dividend, that would be a reason why you want to invest. You do not, I'm gonna repeat this again because this is so important. So many newer investors, especially when it comes to dividends, make this mistake. They look only at the dividend percentage and they just want to invest their money into a higher dividend because it's higher cash flow. That is a huge mistake. You do not want to be doing that, because if that's how you're investing your money, you are at huge risk, because then you could be one of the people that's investing your money into a very volatile company or into a company that's on its way down, because companies can also cut their dividends. Here we talked about a company raising their dividends because they're growing, they're more innovative, they're creating more products. But if a company is doing the opposite because they didn't do your research, well, then they could be cutting their dividends. The share price is going down, they're cutting their dividends, they're getting rid of them, and that makes the stock less attractive, which can also put the share price even lower. So it could be a more positive spiral or a negative spiral, but in order for you to make a good investment, it requires you to do your own research. Now I'm going to talk about how do you find good dividend companies and dividend ETFs in number 5, but if you want to know how do you actually research this, this is where your stock market education, your financial education comes into play. If you're looking for some extra coaching coaching on how to do this, you can check out Market Insiders. It's an investing education app that I created where every week you get access to coaching sessions in the stock market, the real estate market, and the cryptocurrency market. These are real life investors, people who have invested hundreds of thousands, if not millions of dollars of their own money, who are giving you coaching lessons every week. So if you want to try out Market Insiders, I'll give you a free 10-day trial for you to go through the whole thing, see if it's right for you or not. And if you want to try it out, I'll put the link for you down in the description below. And the last thing that I want to mention about being a smart dividend investor is understanding how do you now stack your cash flow. Because if you're looking at this and you're saying, all right, Jaspreet, you know, this is cool and all, I understand the costs, I understand the cons, but I still like the idea of dividend investing and I just want to build this passive cash flow machine that's paying me every single year that I can live off of, great. But the way that you can get there faster is by following something called DRIP, the Dividend Reinvestment Plan, which says that now when you get paid a dividend by a company, instead of you taking this cash, going out and buying something nice, you're taking this cash and using it to buy more shares of the company. That way, every single time you get dividends, you get more and more dividends because anytime you get paid, you're buying more shares of the stock that's paying you. You get paid some more, now you use this cash to buy more shares of the stock that's paying you. So it's kind of like buying a machine. So you buy this asset that pays you with cash flow. Now, anytime you get cash flow, you buy more of the machine that pays you with more cash flow. Now you get more cash flow and you start buying more of this. That way you can get even more cash flow. And you keep doing this again and again and again. And over a number of years, what you'll see is that your cash flow will just keep racking up. And it's like that snowball. It gets bigger and bigger and bigger. And initially, the first couple of years, you're not going to see a massive increase, but it starts to get bigger and bigger and bigger over time because the way that this works is now you're going to keep using your own income that you're getting from your job or your business or whatever to keep buying more shares of this company. And then anytime you get paid a dividend, you're also going to use this dividend to buy more shares of the company. So you're buying more share of this income producing machine and you want to do this as fast as possible. That's why you keep putting more of your own money and you keep reinvesting your money into it. That way this machine can keep paying you more and more and more dividends. That way you can build a passive income machine, but it requires you to do that research. And if you can do this, that's how you can get the biggest returns. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide that goes over what passive income is, how to start generating passive income, and different passive income strategies. These are things that you can start doing even if you don't have a lot of money. So if you want to read this free guide on how to start generating passive income for free, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.